Welcome. There's a tidal wave building in the markets right now, but this isn't the kind that lifts all boats. In fact, it's threatening to sink an entire continent of stocks. So today, we're going to break down this AI scare trade, and more importantly, figure out exactly where the lifeboats are.
And that brings us to the big question, right? The one that's probably on every investor's mind. Is your portfolio safe? Because let's be clear, this is not just some minor correction we're seeing. This is a massive, fundamental reevaluation of value, and it's being driven by the very same technology that was supposed to be everyone's salvation.
This quote just nails the essence of what we're talking about today. We are literally witnessing a great escape. Capital is fleeing the vast, once promising continent of software, which is now being flooded by the very AI wave it helped create. And where's it all going? To the safety of tangible, real-world assets. All right, let's dive right in. Before we can even think about finding a safe harbor, we first have to understand the storm. Why on earth is the promise of AI suddenly scaring capital away from software? This brings us to a super important concept, the AI scare trade. Now, the twist here is that this isn't about the fear that AI is going to fail. No, it's the exact opposite. The panic is coming from this growing belief that AI is going to succeed so spectacularly that it can make entire business models, I'm talking everything from logistics to coding, basically obsolete, overnight. And look, here's the proof, plain as day. This chart shows a really clear capital rotation. You can see money just pouring out of the software ETF. That's a fund tracking all the big software companies and flowing right into consumer staples. The companies that sell things we have to buy no matter what the economy is doing. It's a classic flight to safety, but the storm causing it is brand new. And this is what that fear looks like in the real world. C.H. Robinson, a huge player in logistics, lost almost 15% of its entire value in a single day. Why? Not because they missed earnings. It's because a tiny AI startup basically announced it could do their entire job, but better. That's the incredible power of this new narrative. So the key takeaway here is summed up perfectly in this quote from Jay Woods. The market's perception has done a complete 180. AI is no longer the tide that just lifts all boats. Nope. Now, it's a sharp blade, precisely separating the companies that are about to be disrupted from the ones that are going to do the disrupting. So if the entire software continent is sinking, where is all the smart money building its ark? Let's take a look at where capital is finding a safe harbor from this storm. Okay, the whole Cisco situation is just a masterclass in this new market reality. They reported strong earnings, should have been great news, right? But the stock dropped hard. And the reason why, as you can see here, was a margin squeeze. The cost of the memory chips they need to build their products went through the roof, and it just ate into their profits. This is a classic bull trap, and it proves one thing. The market now cares way more about the quality of earnings than it does about simple growth. And this big shift is leading directly to a new concept some people are calling HALO, heavy assets, low obsolescence. What's happening is that investors are rotating out of that high valuation software, which is so vulnerable to AI, and they're moving into tangible assets. Companies with real-world infrastructure that AI can't just code out of existence. And right here, we see the other side of that Cisco trade, Micron. See, they're the ones selling the expensive memory chips that cause Cisco's margin squeeze. They are perfectly positioned to profit from this absolutely insatiable demand for AI hardware. And this isn't just hype about some future potential. We're talking about real earnings, right now, driven by a very real supply shortage. Now, of course, none of this is happening in a vacuum. The AI scare trade is actually being amplified by much larger forces in the global economy. So let's zoom out and look at the macro picture for a minute. It all kind of kicked into high gear with this one number, 130,000 new jobs, which was more than double what anyone expected. Now, a strong economy sounds like good news, right? Well, not necessarily for the market. You see, that surprisingly strong jobs report forced the market to completely rethink its expectations for when the Federal Reserve might cut interest rates. All those hopes for an early cut, they just evaporated. And the timeline got pushed all the way back to July at the earliest. This higher-for-longer interest rate environment is basically poison for high-growth software stocks that absolutely depend on cheap capital to fund their expansion. And, just to make things a little more complicated, we have these geopolitical wildcards. For instance, recent reports about Russia have sent shockwaves through the commodity markets. You can see it right there in that sharp drop in gold prices. These kinds of unpredictable events just add another layer of uncertainty, pushing even more investors to seek the perceived safety of those tangible assets.
So now for the most important question. What do you do with all this information? How do you navigate these really treacherous waters? Let's lay out a clear, strategic chart for the path ahead.
So what's the move? It really all comes down to the next big inflation report, the Consumer Price Index, or CPI. This table right here lays out a simple playbook. If inflation comes in right where everyone expects, it could be a signal to start buying the dip on some really high-quality software stocks that have been unfairly beaten down. But, and this is a big but, if inflation comes in hot, the panic could get a whole lot worse. In that scenario, the play is to reduce your tech exposure, raise your cash levels, and find shelter in those consumer staples. And that really leaves us with this one final thought. It seems like the market has chosen legacy software as a sacrifice to the new, all-powerful god of AI. The strategic choice for you, then, is not to be the sacrifice. It's to find the arc, the tangible assets, the profitable hardware makers, those steady consumer staples, and to ride out this storm with a very clear understanding of the new world we're all sailing into.